So SoFi reported their Q3 earnings yesterday, and it's fair to say they were fantastic. They managed to beat analyst estimates and their own Q3 guidance on the top and bottom line, as well as also increasing their full year 2021 guidance and posting impressive product and user growth, which are important KPIs for the company's future success. Now, the stock surged more than 15% in the after hours and pre-market today, and it seems SoFi is finally starting to get the recognition that at least I feel it deserves. This is a great business and brand which I feel is going to continue winning in the future, and the stock will hopefully reap the rewards of that. So in this video, I want to analyze the latest results and what they suggest about the long thesis for SoFi, as well as get a feel for if SoFi stock is still at a good enough price to warrant buying more today. Just before we jump in, I just want to remind everyone or anyone new who's watching, this is more or less an update on the progress of SoFi, not a deep dive into their business, which I have done previously on the channel. So if you're looking for more context on the business and why I feel it's going to succeed long term, please go ahead and watch those videos first. So the quarter itself, firstly, members grew significantly. They added 377,000 new members in this quarter alone, and that's a huge number for what is a relatively infant company. That measures to a year-over-year growth rate of around 96%. And one thing that's really great to see is that this growth rate is increasing year over year. We can see in Q3 2020, the growth rate year over year, or the compound growth rate was 74%. In Q3 19, it was 37%. It's now up at 96%. And so unlike what you see with most companies, SoFi's momentum in terms of its member growth is actually going forward, even with the base to grow off becoming larger and larger. They're now at almost 2 million members or customers, and they're still growing in excess of 90% year over year. It's very impressive. Needless to say, almost doubling your customers every year will have a profound on the business long term, even with modest levels of monetization. So this is engine one of their twin engines for the non-financial KPIs. That's members. Second, here we have products. And this products page is the aggregate number of products that are used on SoFi's platform, and that's growing even faster than the number of customers, which is important as it tells us that products used per user or products per user is increasing as well, or increasing every quarter and year over year, which is a very important KPI for SoFi because of the strategy that it has. Essentially, they're at 1.5 products per user versus just one around 2 to 3 years ago. And this not only boosts the revenues per user as they're using SoFi's platform more and also going over to more products on just the one app, but it also reduces the customer acquisition cost, therefore improving SoFi's economics, unit economics, but it also makes the platform more sticky. So it has this sort of moat effect to it as well. So it will help boost customer retention over time and obviously create a switching cost factor as well. So remember, SoFi is an all-in-one, fully digital banking and financial services app. So having just 1.5 products per customer isn't going to be their long-term aim. They're going to want to get that up into the sort of 3 to 4 range if they can. And they have a full selection of products that can appeal to customers in order to achieve this goal. Now, some people have argued that SoFi is too concentrated in lending, which makes it somewhat fragile to high interest rate environments and also recessions when the demand for lending drops or defaults on loans rise. And that is a very fair statement. It has some truth to it as well. But what we're seeing here on the product side of things, definitely in this quarter as well, is non-lending products growing at almost 200% versus just lending growing at 15%. This means little at the moment just because lending generates a lot more income than the financial services products over here, but it does at least show that momentum is building and SoFi will eventually rely a little bit less on lending as their primary revenue source. Now, additionally to the core customer-facing business, we've got the exciting fintech business, which is Galileo. And if you don't know already, Galileo provides payment processing technology and other services to digital banking companies and financial services companies. There is a lot to be excited about with Galileo. I must say they're growing, as you can see, customers and accounts very quickly, 80% year over year, which is impressive when you consider that their customers are essentially neobanks and fintech platforms. So they're commercial customers. There's not as many out there to grab hold of. And when you think about a world where digital banking and digital finance is the future, Well, Galileo is essentially the tax man. So it's a very exciting portion of the business. Also helps that it's growing very quickly. And you add to this that they're also starting to actually produce some fairly big numbers on Galileo. What was a small $800,000 business 2 years ago is now doing almost $200 million in annual revenue. So it's growing very, very quickly, and it seems like it's not close to stopping anytime soon. And so what all of this meant for SoFi's financial performance was obviously very positive. The quarter alone, revenue was the highest that it's ever been at 277 million. We also had adjusted EBITDA at 10 million, so that's a fifth consecutive quarter of positive adjusted EBITDA, whilst investing heavily for growth as they should be. And both of these metrics beat the consensus and also beat their own Q3 guidance that they gave earlier on in the quarter. Now, on an annual basis, their revenue is up to 912 million with adjusted EBITDA at 37 million. So hints that the economics are getting gradually better and better for SoFi, as we can see here in this trend upwards. And what caught a lot of people's attention, including mine, was that they had no choice but to raise their full year 2021 guidance to in excess of 1 billion, implying a 61% compound annual growth rate year over year for this year. This is all whilst the business actually had some headwinds from the CARES Act extension earlier on in this year. So well done to SoFi. Now, although this is great, remember this is just one quarter of the year or year, even with the full year guidance. We can't get too carried away by near-term performance, but everything is moving in the right direction, I will say that. One big factor separate to revenue growth, though, and members growth and all of the KPIs that we do need to focus on and point out is actually this business isn't profitable on a net basis at the moment. And can it ever be profitable? How far away is it from profitability? They're the questions we need to ask ourselves, and they are important questions. At present, they're not returning a profit or a net profit. They return an adjusted EBITDA profit, of course. That shows you the potential earnings power that the business has at the moment, but it shouldn't be used as definitive because they are stripping out some costs that at the end of the day are costs that the shareholders of the company eat. It's not necessarily cash that comes out the company's account, but things like dilution, share-based compensation, the shareholders of the business do eat that. So it's something that we do want to think about. And so to get a feel for if SoFi can be profitable and how far away it is from profitability, let's draw back to what SoFi's long-term strategy is. And it's first of all to acquire as many customers as possible to the platform and then leverage their suite of products to create what they call a financial services productivity loop. Essentially, the success in acquiring the customer for one product and that customer enjoying the experience of that product leads to the customer trying and enjoying new products, the next product, and the loop continues and so on and so forth. But the magic here is that when and if this is achieved, it significantly increases the lifetime value, i.e. the revenue generation of that customer, and gives SoFi the lowest customer acquisition cost possible. In practice, this makes a lot of sense and it makes SoFi's business very profitable and sticky at the same time. They demonstrated this to us in their investor presentation by showing that their average variable profit margin for a multi-product customer is around 80%. This is versus just 34% for a single money user or a single product user. Essentially, the strategy that they're deploying here is the free to low cost products, being the banking and financial services ones, attract customers and usually originate loans to some of those customers at some point throughout their lifetime, although they still do make some money, as it seems, on the financial services or freemium products. So my convictions are, yes, SoFi could be and can quite comfortably become profitable in the future, but it shouldn't be prioritizing profitability at the moment. They should be prioritizing the growth of the customers, growth of the platform, and also improving the experience of the platform first. That's what's going to create the most long-term value for shareholders of SoFi, not prioritizing their profitability now. Remember, they set themselves a 5-year target or 2025 expectation that they could reach 1.2 billion in adjusted EBITDA by 2025, and that's on 3.6 billion of revenue. So it implies a pretty healthy 32% profit margin. One thing we haven't covered or haven't added to this is the boost of a bank charter, which will no doubt benefits SoFi in a big way. We haven't actually had any news on it yet, but there is a conditional agreement, and they've even acquired a bank, which was Golden Pacific Bancorp, in the effort to speed up the process. We've still not got confirmation, like I say, but there is a lot of hope that it will be fully approved very soon. The benefits to SoFi for having a bank charter are significant. It will increase SoFi's lending capabilities, lower their cost of capital, enable increased growth in lending, and give them much better margins. They even demonstrate it here in their investor presentation, where they suggested they could reach $1.5 billion in EBITDA by 2025 if they receive the bank charter, which would be an unbelievable metric if they could hit that, especially coming from where they are coming from today at not even 1 billion of revenues. So the future looks bright for SoFi right now. I think we have clarified that. It does have some risks, one being a small business in a very large and competitive market, but it also has, I feel, the characteristics to continue succeeding as it is today. And those characteristics really being that, one, they've got a sticky platform with high customer retention. This helps to create, hasn't got a wide moat at the moment, I admit that, but helps to create a wide moat for the business in the future. Second characteristic being they arguably have the best optionality out of their peers and are up there in terms of the highest quality products as well. The third is that they have a very good brand. Most people associate SoFi with actually helping people and them being mission focused as well. Remember, their mission is to help people get their money right. And then the last one, but not least, is that they have a very large addressable market and very long runway for growth. I think they pegged their market or total addressable market as being almost 2 trillion, which is obviously a bit excessive, but it just demonstrates to you that, financial services is a huge market, and but those are just 4 factors or 4 characteristics that I think are really going to help SoFi continue winning into the future. But I do just have to cover the risks and what I think we should look out for. It's always good to look at it from a balanced point of view, just be aware of what the downsides are, because inevitably with everything, there always is some downsides. Now, the one clear thing at the moment is that unfortunately they can't run from the fact that they are heavily concentrated and reliant on income from lending for now. And this could be fragile in a higher interest rate environment, like we spoke about before, and in recession periods where people can't repay their loans. So although they're trying to get away from that, trying to move away from that, it seems like, at least in the near future, they still are going to be very lending focused. Now, the second concern, we touched on it a little bit, and it's that they're in a fast-paced and highly competitive space. So we are really relying on SoFi's management to execute well and maintain the quality of its products and services, and even innovate if need be. And of course, there are obviously more risks than we've just covered here, but these are the 2 factors that I'm thinking about and that I'm keeping at least in the back of my mind when I'm looking at SoFi and tracking its progress. And so lastly, we're going to get a feel for the valuation. Just to answer the question that we had around, is SoFi still at a reasonable price today, and how much upside is left in the valuation after it has risen pretty significantly? And you might know I own SoFi already, picked up shares pretty early on, so it's done quite well. But with all of the progress we're seeing, how does SoFi look today in terms of value and returns? Now, the shoot up in price has got it to an enterprise value of almost 17 billion. So it's definitely not a small company now in terms of its market cap. It's actually a relatively large one. But we're going to be using this 5-year DCF analysis that you see here and that I previously did on SoFi. And this is essentially I'm calling it the top quartile, and it's my bull case that I'm using. And it mirrors essentially what we saw from SoFi's management that they said they expect to do over the next 4 to 5 years. And considering how well they're doing at beating expectations today, it might not be a bad indicator at all. So we're going to use it. Remember, they expect 43% compound annual growth up until 2025, which gets us to close to 3.7 billion in revenue. They're already at $1 billion in revenue in 2021, so I really wouldn't be surprised if we see them exceeding that, although you do have to say tripling their revenue in the next 4 or 4.5 years is going to be a tough task in itself. Now, margins are really what's interesting and what probably could be up for question. 32% EBITDA margins they're targeting in 2025 and a 20% net income margin. Do we think that they can get to that? I'm not entirely sure. but it all depends on how quickly they grow the business. Do they still prioritize growth in 2025? If they're growing in excess of 30%, that would mean that there's still a lot of demand from new customers. I would probably like to see them prioritizing growth at that stage, but we're going to go with this hypothetical metrics that they've given us anyway. Essentially, using our comparable multiples, which is 30 times earnings and 10 times sales, that is lower than what I'd say actually is comparable in fintech businesses, because fintech businesses is around about 40 to 45 when you look at SoFi's competition, but I'm definitely not comfortable putting 45 in my 5-year model for now. I'm going to go with 30 on the expectation that the multiple could contract. And anyway, that gets us to an intrinsic value for the business today, just based off of their numbers, of about $20 billion or $25 per share. So we're still slightly undervalued, only around 4 to 5% upside at the moment, but it's good signs, because really this DCF model doesn't do us a huge amount of justice, in the sense that growth isn't just going to stop in 2025. If you carry this on for another 5 years, which is the runway that SoFi have, the fair value may look a lot more favorable. And also this forecast here implies that growth is going to slow year on year. They're currently growing at 65%. This model implies growth slows every single year up until 2025, which, if we're taking members and products as a proxy, the growth in members is actually speeding up year over year. So we have to keep that in mind. There could be a lot of upside in this valuation that we haven't packaged in, but even just going off of their numbers, their expectation, the stock seems fairly valued today. And if you bought early on when we did this video a few months back, or even earlier in the year when the stock was trading at around 13 to 16, then you've done well so far. And I would suggest holding on to SoFi. That's what I'm going to be doing with my stock. Anyway, I probably won't be buying more unless we see some weakness and we see it drop back below 20, back below 18, maybe then I will add to my position in SoFi. But for now, I'm a very happy shareholder in SoFi and am very positive about the future of this company. I think it will continue to be a winner in the fintech space, and the stock should continue to do well as a result. And so that's all for this video, guys. Just an update on SoFi after they've posted their impressive results. As always, let me know what you think in the comments of SoFi, and whether you have bought either previously or looking to buy now. I'd be keen to get your opinion on where you think the value of this company sits at. I will leave a link in the description to the Patreon, where you can get access to all of these valuation models here, or this quartile analysis on SoFi, as well as many other companies as well that we have valuation models on. You also get access to exclusive analysis, my portfolio of stocks, and things like that. So go ahead and check that out if you're interested in supporting the channel. But other than that, if you could leave a like on the video, subscribe to the channel if you haven't already, and I will see you all in the next one. Good luck with all of your investments.